Good afternoon and welcome to Unlock the Stock. As you know, this platform is designed for retail investors to gain access to corporate management and to get to know them and their companies better. This episode is sponsored by Easy Equities, the platform that helps you to grow and protect your wealth so you can invest in local and international shares, property, unit trusts, crypto, bonds, and actively managed ETFs. Plus also get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We are very pleased to welcome CA&S back to the platform, and we are joined today by Duncan Lewis and Frans Rech, who will take you through their presentation shortly, which includes a short video. Unlock the Stock is only possible, of course, with our technology partner, Lumi Global. Please visit their website, lumiglobal.com, to learn more about their various online AGM and investor presentation solutions. With Mark Tobin away in Australia, today's Q&A session will be hosted by the Finance Ghost. Before we start, just a few housekeeping notes. Duncan and Frans will take you through the presentation, followed by the Q&A. You can post your questions by typing them into the chat box at the bottom of your screen. This event is being recorded and will be available on our YouTube channel soon. And you will see an email address before we begin the Q&A session, so please note that if you'd like to be added to the CA&S investor distribution list. I'm now handing over to Duncan and Frans for the presentation. Thank you.
Good afternoon, everybody. It's a great pleasure to be with you this afternoon and to share with you our half-year results for June 2025. We're going to cover a little bit about who we are, what we do and why, a little bit of a deeper dive into our business model, the interim results, and then an outlook for the balance of the year and beyond. For those people who are new to the forum and don't know our business that well, the CA&S Group specializes in providing route-to-market solutions for brand owners, specifically of consumer packaged goods. Route-to-market solutions are simply around how we execute in the different retail environments, ensuring on-shelf availability of brands in the respective retail environments and making sure that ultimately we implement the look of success that hopefully generates in sales for our brand owners. What I'm going to do is I'm going to play a short video that will give you a deeper dive into our business, what we do and why.
At the CA&S Group, we know growth is never achieved alone. We are a collective of businesses united by a shared purpose, the power of and. This means combining the power of scale and precision, execution and insight, reach and relationships to unlock growth for the brands we represent and deliver value to every stakeholder we serve. Over decades, we've earned our place as a trusted partner to many of the world's most respected brands, ensuring their products reach millions of households across Southern and East Africa. Our performance is clear, but our ambition extends further. What sets us apart is our edge, the ability to deliver solutions at scale while executing with local precision. In the world of consumer packaged goods, every store, every shelf, and every shopper matters. The details drive the outcome. Our client partnerships are at the heart of our business. Their growth is our purpose. Their success is our success. By understanding their goals and connecting them to insights across markets, we become more than service providers. We become partners in growth. To stay indispensable, we must be future fit. That means investing in data and scaling intelligence across borders, giving our clients unique perspectives on consumers, channels, and performance. We are actively driving digitization across our operations, moving beyond logistics to deliver integrated digital commerce solutions. From smarter reporting to omni-channel execution, our mission is to help brands win at every touchpoint in every market. East Africa is one of our continent's most dynamic consumer growth regions, and we are strategically investing to be part of its momentum. At the same time, we're building a strong presence in townships and the general trade economy, where millions of daily transactions shape brand success. Beyond our core, we are preparing for the next categories of growth. Private label is on the rise, and we are ready to help retailers build and manage these emerging propositions. And as brands on the edge of global portfolios change hands, we see unique opportunities for stewardship, expansion, and value creation. But growth must be sustainable. Our ESG commitments are embedded into how we do business, with a strong focus on education, because we believe real growth goes beyond financial results. It empowers communities. CA&S is a business built for today, with the energy and a vision for tomorrow. We're scaling our current operations, expanding into high-growth regions, and investing in digital, data, and new retail channels. But above all, we remain true to the power of "and." Because when we combine scale and precision, insight and execution, people and technology, we unlock extraordinary growth for our employees, our clients, our communities, and our shareholders.
So I often get asked is how we remunerated from brand owners. So broadly speaking, we provide brand owners with a walls, wheels distribution solution in country, and we provide them an in-store execution solution in these countries. That means is that we take responsibility for the stock from the time it arrives at the back door, in other words, the storerooms. We pack the shelves, and then we do the promotions in the store, and we engage with the shoppers and the consumers, often talking about features and benefits. We execute these promotions based on seasonality and what the brand owner, the retailer, wants to promote. We also providing insights around what's happening in the retail environments, what RSPs are, what selling prices are, what competitors are up to. And the brand owner pays us a fee for executing on their behalf. So we don't make a margin on the product, but we make a margin on the fee, a margin on the service we provide the brand owner. I think that I often get asked is why we prioritize certain markets. So we have a very well-established business in Southern Africa. That's South Africa, Botswana, Lesotho, Namibia, Eswatini, Zimbabwe, and Zambia, and more recently in certain geographies in East Africa. We prioritize markets based on where clients want solutions, but also geographies where we believe we can navigate the complexities. And that includes making sure that we can get paid and we're comfortable with social, political risk, etc., etc. In East Africa, we see rapid urbanization. We see GDP growth of between 3 and 7% in certain markets. With the rapid urbanization and GDP growth, we see modern trade evolving and evolving very, very rapidly. And we've got a growing middle class, albeit off a fairly low base. And these are all catalysts for growth in our own organization and for the brand owners that we represent. I think that what I want to highlight here is that We're an operational execution business, and we do that through capability building of our staff. That means recruiting, onboarding, and developing the best staff, equipping them with the tools and the skills and technology to do their jobs, and making sure that they execute in these retail environments, ensuring, I guess, availability and visibility of product, and making sure that we can report back to clients, to retailers around the efficacy of that implementation. I think that if we talk about how we deliver, we are able to provide brand owners with a solution in country that is very robust. That means that we service many of the retail environments. That's modern trade, that's general trade, that's pharmacy, that's convenience, that's quick service restaurants, etc., etc. And so when a client uses us for their service, they know that many retail environments are being serviced and serviced well, and through that they get very good distribution in a particular country. I also think that an important thing to mention is we have very deep in-country roots. What I mean by that is that although the business was established in 2012, the businesses that make up the group go back many decades. And for example, our Namibian business is over 80 years old. Our South African business was established in 1976. Our Botswana business over 40 years. And so we understand those geographies very, very well. I think what's also worth mentioning is that the average client has been with us for 19 years, and many of the clients go back with us for 3, 4, and 5 decades in some cases. That means we understand the brand owner's business, but we understand the brands and the brand's role in particular categories. I think that if you look at the CA&S Group, that stands for collaboration and then activation and sales. So we collaborate with brand owners, understanding the role of the brand in a particular retail environment. We activate in store, and if we do that well, it generates sales. I also think that we have very, very strong organic growth plans, and if we execute well, we deliver on organic growth plans. That means we grow market share, we grow channels, and we're able to grow geographies. But also, I think that we have acquisitions, and acquisitions in existing geographies might be for strategic reasons around capability building, channel broadening, or new geographies like East Africa, for example. If I fast forward to the half-year results, if you look at revenue, we increased revenue by 4% for the half year to 5.955 billion rand. Operating profit increased by 9.6% to 335 million rand. Earnings per share increased by 15.5% to 50.72 cents per share. Headline earnings increased by 16.9% to 242 million. Headline earnings up 16.1% to 50.44 cents. And lastly, net asset value per share up 17.3%. If I look at the various jurisdictions, you'll see is that with the exception of Botswana, we were able to grow revenue. I think Botswana revenue for the half year was 2.826 billion versus the 2.852 for the previous period, so a contraction of almost 1%. Eswatini, for our portfolio of businesses, they're growing by 7%, Namibia 6%, South Africa by 13.1%, and all other, and to be clear there, that is Lesotho, Kenya, Zimbabwe, and Zambia by 13%. If we unpack Botswana specifically, you heard me talk about the revenue contraction by almost 1%. If you look at the earnings, EBIT, 131.8 million, that is a contraction of 1.5%. I think that if you look at what happened in Q1 and Q2, Q1, I think that we had poor inbound service levels from some key clients around shortage of raw materials, which impacted us. But also, I think that if you look at Botswana in general, I think that the issue of the reliance on diamonds, the move to synthetics, and how it is impacting the Botswana economy is well documented. I think from our perspective is that what is out of our control and what can we control. I think that we're very focused in making sure that we're using this period to ensure we remain operationally effective and efficient, making sure that we're managing our costs appropriately. That is making sure that we are very focused on stock value, resource deployment in terms of people, and our team have identified some efficiencies that they can bring through the system. And we remain confident that we can navigate the headwinds in Botswana and still have a sustainable, profitable, and fairly predictable business in this environment. I think that we are also using this period as opportunities to grow market share. That means we need to be dependable, reliable, and stable. And we believe that we are able to grow our new business pipeline at times like these. And so the team is also focused on that. I think it's worth pointing out is that the Botswana government are very focused on reducing reliance on diamonds. One can argue it's a little late, but I think, in my view, it's never too late to do the right thing. And this is some examples that we found in the public domain of investment commitments, either from Australia or Japan or Qatar, around strategic investments to drive other industries, whether it is tourism, mining, agriculture, etc., etc. If we look at Eswatini, or formerly Swaziland, we grew revenue in this jurisdiction by 7% to 898 million. Although EBIT was only 66.6 million, which is a contraction of 6.4%. I think that this jurisdiction remains strategically important to us. We continue to invest in this geography. We continue to build capability and capacity in this geography. And part of the earning contraction is our investment in capacity and capability building through some technology initiatives, people, etc. But also, we've started to develop a new facility, a 25,000 square meter facility. If you look here, you'll see the renderings of this facility. So we have already done the earthworks. We have done the construction of some of the slabs, etc., etc. And we expect to move into that facility around Q3 of 2026. And we expect that the project will end up being about 280 or 300 million, between 280 and 300 million rand project for our Eswatini geography. If you look at Namibia, we were able to grow revenue in this geography by 6% to just over 1 billion rand, but EBIT growing considerably to 29.8 million. I think that you may remember we did the acquisition of Tobin in 2024. Spent a lot of time bedding down that transaction, migrating, exiting customers to different solutions. And we're very, very confident that we can continue to grow this geography. We would still consider us being under-indexed. So if you look at the clients we represent in other jurisdictions, we still believe that the gap between ourselves and competitors in some cases is too big. And so we're very, very aggressively looking to grow our market share in this geography. I also think in Namibia, there's lots of news around oil and gas being found off the coast. I think that we're sincerely hoping that the macro environment improves, because that'll be a catalyst for accelerated growth for this economy. South Africa, our South African business, growing by 13.1% to 989 million. EBIT growing by 14.3% to 88.6 million. We're delighted with what's happening in this geography. We're growing market share considerably. We're growing our main market channels at an accelerated rate, and we're growing with existing clients in this geography. So we're very, very pleased with the momentum we're starting to build in this geography. If you take all other, a fairly small revenue contribution of 174.8 million, and EBIT growing by 8.5%. Traditionally, this just included Zimbabwe, Lesotho, and Zambia. More recently, it includes Kenya. But I just want to remind the audience that we did the acquisition, but it was only effective the 1st of March, and we bought a minority stake of Tratco based in Kenya. I think that if one talks specifically around the East African acquisition, if you know our business, we target ideally owner-operator businesses that have a history of making profits, that ideally number one or at least number two in the markets they serve. We believe we have found the right partner in this geography. So we have roots in Kenya, Tanzania, and Uganda. We really like this management team, and we're working very, very hard to build capacity and capability here and use it as a platform for accelerated growth. At this point, I'm going to hand over to my colleague, Frans, to talk in more detail around the primary statements. Thank you, Frans.
Thank you very much, Duncan, and good afternoon to all our online guests. You look like ghosts to me because I don't see any one of your faces now, but welcome. The 6 months of revenue growth of 4% was slower than what we anticipated. The Botswana segment experienced some headwinds, which, as Duncan mentioned, related to our customers that are under pressure, and some service levels that were lower than usual due to supply chain issues, raw material issues specifically, and that generated the 1% negative growth in Botswana. Liquor was also under pressure in Botswana and Eswatini, but also due to the customers that are under pressure. Operating profit of growth of 9.6% to 334.6 million. The increase in this related to the increase in gross profit from 15.2% to 15.9%, cost management, and the increased income from associates contributed to the operating profit growth of 9.6% and the higher profit after tax margin. Through margin increases, new acquisitions, and a lower tax charge, headline earnings per share growth of 16.1% to 50.44 cents, despite a low growth of top line of 4%. On this slide, I'm just going to touch the revenue. There's 4% revenue growth of to 5.9 billion is made up of 4.4% relating to the acquisition of Mac Mobile we did in the last quarter of last year, and 3.7% relating to acquisition to organic growth. And that organic growth we can further split down between 1.9% on new clients, price increases of 3.1%, and a decrease in volume of 1.3%. We continue to maintain a healthy balance sheet with good cash reserves. If you look at our non-current assets, the increase in that relates to the cash that the acquisition of the East Africa operation Tratco for 108 million. Our long-term borrowings, there wasn't any material movements on that line, which is made up of basically operating leases, and the mortgage loan on the property that we bought in 2018 in Botswana. Our current assets, the breakdown on the left-hand side, you'll see 22% relate to inventory, 47% to trade and other receivables, and 31% cash and cash equivalents, which includes a cash balance of 1.3 billion rand. Our current liabilities on the right-hand side, mainly made up of trade and other payables of 61% and 32% on borrowings, which includes an overdraft facility of 582 million, which we use as part of our cash management in the funds that we have in Botswana, Rand, and the Pula to maximize our interest benefits. If you look at working capital, our working capital days have increased with 5% from year end. That was mainly due to the cutoff that we did on 30th of June as a hard cutoff, and also some of our customers, major customers, have only settled their accounts on the first week of July due to their year ends, with which, our debtors book is healthy. We've got minimal bad debt write-offs, and we're confident that we can reduce these debtors days at the end of the year. If you look at our cash flow, we had to invest, due to the higher working capital days, we had the investment in working capital of 55.3 million. Our profit from operations, excluding working capital, has increased from the previous 6 months. As you can see, tax paid, we've got a lower tax expense for the first 6 months compared to the previous 6 months. The net investment of 108 million relates to the funds that we allocated to the acquisition of Tradco in Kenya as part of our expansion strategy in different geographical areas. Net capex of 73 million is made up of a work in progress of the facility in Eswatini, which at this stage is just 46 million spend, and the rest is expansion and replacement of our fleet and some renovations we had to do in our properties in Namibia for new tenants. The group has sufficient funds available to fund acquisitions and its organic growth to reach our strategic goals. The first 6 months of 2025 was challenging, but because of our diversified portfolio in the different countries and our clients, we were able to produce a satisfying set of half-year results. Thank you very much. Thanks, Duncan.
If I just look at the outlook, I think that our ambition remains to achieve 20 billion rand revenue. Attaining this milestone will not be the end of our journey, but we will continue to strive for sustainable, profitable growth as we provide existing and new brand owners with solutions in emerging markets. I think that this growth will be achieved in the following ways. If we look at the tile number 1, we talk about grow our sub-Saharan core, optimize our foundational businesses. So if you look at South Africa and our neighbors, BL&E, we are servicing 70 million consumers there. But in these geographies, we've got an average of probably 1.5% GDP growth. And so our growth is not going to come from economic growth. Our growth has got to come from other areas. And we're working very hard to make sure that we grow market share over this period, is that we continue our channel broadening process. An example of that would be in the main market. You saw that we did the acquisition of Roots, the 49% share that we bought in Roots, which is a main market solution. We established a car seat sales solutions, and both those vehicles are gaining momentum, and we're providing more and more brand owner solutions in that market, which some say makes up 50% of the total grocery market in South Africa, which will give you some sort of insight into the potential there. I also think that private label and so-called periphery brands are growing. We're seeing private label make up almost 25% of the retail basket. Some retailers have an ambition to increase that to 40% of their contribution. They're using that as a point of differentiation, but also an opportunity to grow margin in that space. And we are developing solutions to make sure that we participate in that area of the retail channel. I also think that if we talk about digital commerce, online, we see it accelerating very, very rapidly, albeit off a small base. And we are we're developing solutions to make sure that we participate in that area, providing existing client solutions there, money they're spending already with potentially other service providers. And that is a combination of capability building through acquisitions, et cetera, et cetera. And then lastly, the East African hub, specifically Kenya, Uganda, and Tanzania. We see that geography or cluster growing at an accelerated rate. Our ambition is to grow that cluster at double digit. And so as we build capacity and capability with our partners, Tratco, we want to migrate more and more of our existing clients to that solution and to grow ultimately at an accelerated rate. So I think that our geographical expansion continues, our channel broadening ambition continues, and our digitization journey. We're spending a lot of money in internal digitization, but also making sure that we are providing clients with insights and providing them with value that they seek. And we believe that if we do these things, we're able to grow our competitive advantage and improve the so-called moat of the business. I think if I move on to the next slide, an important part of that is what we call the power of and. So the group is made up of over 20 businesses in different geographies, and we have a very good leadership team, and there are pockets of excellence in these individual businesses. We're working very hard to make sure that we understand where there are pockets of excellence, how we can replicate it in other geographies, and use that as a way of improving not only the company DNA, but improving the group's DNA and our overall offering and competitiveness. That is made up of 3 broad initiatives. One is our people, our data and quality of data, and ultimately our thinking to make sure that we remain relevant to consumers, retailers, and brand owners. I'm now going to hand over to the Ghost and Unlock the Stock team to take questions from the viewers.
Thanks so much, Duncan and Frans. As always, an incredibly good presentation, and I hope our attendees got some background on the group. We're going to now kick over to the Q&A session with the Finance Ghost, and a reminder to add your questions to the chat box at the bottom of the screen if you've not done so already. So Finance Ghost, over to you, please.
Thank you, Deborah. Hello, everyone. Congratulations, Duncan and Frans, on another solid set of numbers at CA&S. You guys have been amazing with coming on Unlock the Stock so many times to engage with the audience. So thank you for that level of engagement with the retail investor audience. And just a reminder to attendees, please do DM through your questions to me. It's just me today. Mark is traveling. So send them to me if you'd like them to be asked. I'm going to kick off with, and I mean, you front-footed it already, as obviously you knew the question was coming around Botswana. That's the word on everyone's lips. But of course, there's also been a nice macro uplift this year in Africa as a whole. I mean, we've seen it in companies like MTN. We've seen it in companies like ABSA, Standard Bank, all over the place, really. I was just wondering to what extent you're seeing some of this actually filter through on the ground, just at a macro level. It feels like this has been a better year for Africa, full stop. And I guess that's good news for your businesses, but maybe it's also making potential acquisitions a bit more expensive. So I guess let's kick off there. Just any commentary you might have around the macro picture in Africa. Starting you with a hard one. Maybe the questions will get easier. Maybe they won't. We'll have to see.
Yeah, look, I think, we've been in Botswana for over 40 years. Botswana has served us well. It's been very good to us. And we are fairly confident that Botswana will remain a sustainable geography for us. I think that we're not naive to the fact that in the short term, there are going to be pressures, and more specifically, pressures on consumers and shoppers. I think that we have yet to see how that manifests. So in other words, is there increased unemployment? Government is the biggest employer there. We've seen the devaluation of the pula for the first time in a long time. And so ultimately, the shopper and consumer, I think, insofar as they rely on goods imported from South Africa, are certainly going to be impacted and impacted negatively. I think that our business operates in a fairly narrow band in the sense that we're supplying essentials. And when economies are doing well, we don't benefit nearly as much. But when economies are doing badly, we're not impacted that much. We see trading down in categories. But I think broadly speaking, I think that we are seeing more and more of our brand owners look to us to provide solutions in retail environments. I think that by and large, South Africa is becoming a tougher place to grow volume, to grow margin, and they see the opportunities that other geographies north of us present. And you heard me talk about urbanization, positive GDP growth, the growing modern trade are all, I guess, signs of opportunity. And we need to, we are trying to be, I guess, be first movers in many aspects and provide a credible solution to existing clients. And we're fairly optimistic that over time we can make it work and be rewarded for the decisions we've made.
Thank you. And if I can maybe just press you on the point around deal-making trends, anything noticeable, anything you can speak to? So maybe prices shifting or availability of assets, because that's also true sometimes when things get better from a macro perspective, more assets come to market and there's more to look at. So obviously, without speaking to specifics, is there any clue you can give us as to what it's looking like out there on deals?
Yeah, look, there's a lot on our radar. There's lots of conversations taking place. But I think that, good businesses cost money, and they cost more today than they did yesterday. So one's got to find the balance between good businesses isn't overpaying and making sure that in your hands, you can use them as a catalyst for accelerated growth. And we're very focused on developing that.
Yeah, fantastic. And in terms of when you look at these acquisitions, I mean, one of the things that's really interesting with your group is that all of the businesses you buy seem to hang on to their brand. So you've got this very interesting disparate group of brands. Now, I think of something like Bidvest as an alternative. It feels like everything Bidvest owns has a Bidvest stamp on it. You guys take quite a different route to that. To what extent can you actually really unlock synergies? Like if you go do more acquisitions in East Africa, for example, do you need to look at a business in isolation and say, this is a great deal as this thing stands today? Or do you actually have the ability to say, okay, maybe we can pay a little bit more because there are actually a lot of synergies. And obviously that's a very slippery slope. And there's a long track record of management teams on the JSE who have gotten that horribly wrong. Knowing you guys as I do, I think the approach you take, it's very unlikely you'll get yourselves on the wrong side of that, which is certainly a compliment. So to what extent are there really synergies across these brands when you're looking at acquisitions?
Yeah, look, I think that, I guess my personal view is that part of our competitive advantage is keeping head office small. So we have 8 or 9 people in head office, and I have no intention of increasing that. And the importance for me is that we push accountability downwards towards the operations. We bought businesses for a specific reason, mostly because we like the management. They're good at it, and we believe that if we are expecting them to be accountable for the result, we need to give them the autonomy to achieve it. So the kind of businesses we buy are entrepreneurial self-starter types. And for the most part, if we interfere too much, they'll say, you know, here's the warehouse keys, you run the shop. And we like businesses like that. I think that in generally synergies, and people talk about synergies, I think they are exaggerated, and they're used as a way of buying businesses, but it's very difficult to land synergies. The synergies we found around the power of and is around ways of working with particular clients. So we understand a brand's role in a particular market, in a particular retail environment, and we know how to execute there. And so if we've taken on a client in geography A, but we've been doing it for many years in geography B, we know how to replicate that success in geography A, and that's been good for us, and that has served us well. And that's why we've had such good organic growth, is really on the back of existing clients.
I think the one interesting thing with quite difficult economic times, and who knows what will happen in Botswana. I mean, as you say, it's employment, it's jobs, it's all of these things. Botswana's been such an interesting case because so many frontier markets are almost dependent on 1 or 2 commodities, and no one has ever talked about Botswana in that light because, you know, diamonds were forever, right? And now there's lots of uncertainty around De Beers, and who knows what happens there. But I guess from your perspective, you know, and you're quite right, like all you guys can really do is manage the business and control the controllables, as the old saying goes. But what is interesting is sometimes when there's very tough times, you'll find a market leader pulls away. So if you are the strongest in the market, then you have an opportunity. Yes, the market might go through a dip, but it actually consolidates market share for you. It gives you an opportunity to maybe pick up weaker competitors, etc. So are you starting to see a shift in competitive dynamics within Botswana? So much as the overall business right now is a bit sideways, is there a lot going on further down, or is that not really happening yet?
I think that, as I said earlier, I think that we can use this as an opportunity to grow market share. And if we remain dependable, reliable, and stable, those opportunities will present themselves, and we will pounce on them when appropriate.
Yep, fair enough. It's going to be very interesting to track how that plays out ultimately. I'd like to ask you something about the underlying product mix, and it's quite interesting. So your business model, and thank you for including that in the slides and just making it so clear up front. You know, you're not participating in the margin that the FMCG player charges on the goods, but you are inside the margin, if that makes sense, because they need to be able to pay you in order to use your services. So does that naturally lead to a place where the more discretionary categories that have got higher margin almost become more natural clients for you? I mean, I'm thinking of that excellent corporate video you showed. There was chocolate, there was vodka, there was all sorts of things. I don't know what it says about me that I noticed those 2 things, but anyway, we'll move on from that. You know, there were Doritos, just to save myself, and there were some staples. But on a serious note, you know, you have talked about the extent of staples, people needing to eat, etc. But do you find that there's a natural sort of participation of discretionary goods? Any trends around that? It maybe just helps people look through and say, what is your exposure to staple versus discretionary?
So I think if you think of a store, of the real estate in a store, you know, we are in most aisles and in most categories, except fresh and prepared meals, etc., we're in most categories. And so mix for me is very, very important. So I look at price per pallet, I look at volume, and making sure that we've got the mix right. So, you know, we would do obviously personal care, home care, snacking, treating. We do beverages, alcoholic beverages. And so we have a fairly balanced basket. And so, we have goods that would sell for several 100,000 rand a ton, and then we have goods that will sell for a couple of thousand rand a ton. And so, if you think of a product like rice, we are seeing probably 30% deflation in the rice category. So, it's not only a revenue discussion, it's also a volume discussion. So just because the revenue, we're having deflation of double digits, doesn't mean the volumes come down. In fact, the opposite's true. Volumes remain static or increase. So it's really important that I get that balance right and I have the right conversations with the brand owner.
I can just imagine how fascinating the data actually gets and the analytics. And that's a point that you spoke to as well, was that data layer effectively. To what extent are you able to have a centralized data bank, and how that might then evolve into something around AI and big data and machine learning and all of the other buzzwords that there are very real world applications for right now? Just referencing the fact you're operating across so many countries, so many different brands. I think if we look at some of the FMCG plays, certainly some of the retail plays, the winners have been the ones who have corporate owned footprints. They can have consolidated data. They can have a beautiful data layer that they can work with. Is that where you are headed? Perhaps it's where you are already. I'm just wondering, in the context of all these different businesses that you're involved in, what sort of data layer have you got across everything? Hard questions today, Duncan. Hard questions.
No, I mean, I welcome it. I think that, primarily we're a people logistics business. We deploy people to an environment to get stuff done. So I talk about, we employ 18,900 people in the business. So we have a large portion of our business is what I would describe as arms and legs, getting stuff done. But we have, and more and more important is the head and shoulders business. Our people, and I think that if we do those things, we have a chance of being relevant and I guess competitive. And if we do those things, we have an opportunity to achieve our growth objectives as a business. So for me, it's primarily around attitude and how we wake up every day.
Yeah, I like that. The pebble in the shoe concept is very cool. That's pretty good. So I've still got time for a few more questions. I may as well put the pebble back in your shoe then, Duncan. And the one I'm going to ask you is around, as your share price has gone up so nicely, and it really has been on an epic growth path for the past few years, which is very well deserved. I think you've been incredibly consistent in your execution, your messaging to the market. It's for all of the right reasons. So genuinely, congratulations. But it gets to a point where if you want to be using your shares to do acquisitions, if the multiple's gone quite high, that actually gets more difficult over time. It's this very weird situation where success makes it harder to do share for share deals potentially because your shares are actually more highly valued. And that's typically the point at which companies switch then to raising, doing equity capital raises to actually say, well, our shares are nicely valued. Let's issue more of them for cash and go and do deals. And of course, it's always easier to go do transactions for cash than it is to go and convince someone to take CA&S shares. So I guess the nice broad question, because you can really only be vague about this stuff, and I know that, is as the share price has moved up, has it actually amended any of your thinking around how you pay for acquisitions, how you structure these things going forward? Any conversations you've had with people in potential deals around willingness to take your stock? Or is it the other way around, where because it's done so well, people actually want it more, and it's easier to convince them to kind of come along for the ride? It's a nice sort of M&A question.
Look, I think what's firstly important is that we don't overpay, and we get the business at the right price, and that the owner-operator buys into the opportunity around using our collective for, I guess, accelerated growth, and they benefit as a result from that. I think that if you look at our business, in my view, we can fund all our own growth, and the businesses that are doing individual acquisitions can afford to do that on their own. My personal view is that Our recipe has always been to buy a minority stake in a business, let's call it 35% like Tradco, and have a path to majority over a period of 2 or 3 years, so ramp it up to 60%. And then ultimately, we want that owner-operator to convert some of his equity to the holding company so that we're all pulling on the same rope. We all have a vested interest. So if you look at the senior leadership team, everybody is a shareholder in the holding business. And I'm saying my bias is towards that. Frans might have a different perspective, and if he does, I'll ask him to jump in. No, he doesn't. So, Ghost, I don't know if that answers your question, but that's my view.
No, it does. It does. It's 100%. Thank you so much. We actually really dug into some interesting stuff today. So what I would encourage listeners, before I just say goodbye and let Deborah close it all off, is go and listen to some of the previous Unlock the Stocks with CA&S. I think it's really valuable to kind of understand the story over time. And see how it's developed. So yeah, that is pretty much all we have time for today. Thank you to everyone attending, and thank you to the team. Good luck for the rest of the year. And Debs, over to you.
Thanks so much to everybody who chose to spend time with us today, and a special thank you, of course, to Duncan and Frans for once again making time to support this platform and to engage with retail investors. Our next session will feature a newcomer to this platform, and we're very excited to welcome Redefined Properties, and look forward to hosting them on Thursday, the 18th of September. And that's pretty much it from my side. So goodbye.
Thank you very much.